Here's a hard truth that a lot of self-employed buyers don't find out until it's too late. You can make six figures, pay six figures in taxes, and still not qualify for a mortgage. And no, it's not your credit, it's how your income shows up on your tax returns. Let me break down how underwriters actually look at self-employed income, because this is where deals die. First, Schedule C income, sole proprietors, and single member LLCs. This one's simple, but it's brutal. Your business income is your personal income. Everything runs through your Schedule C on your personal tax return. Underwriting starts with net profit, not gross revenue, not deposits, but the net profit after your expenses. Now, there are add-backs that might help, like depreciation, depletion, business use of home, one-time expenses, but they're reviewed carefully and they're not automatic. There are also things that hurt more than people expect, like meals and entertainment, disallowances, or losses that might happen every single year. If you own 100% of the business, there's no ownership adjustment, so what's there is what counts. Income is usually averaged over 2 years. 1 year can work with strong compensating factors, but that's not always a guarantee. Schedule C is the easiest structure to calculate, and it's the hardest one to qualify if income goes up or down. Next, S-Corps and LLCs taxed as S-Corps. This is where people get really confident and then get very surprised. Income is split between W-2 wages and K-1 income. Underwriters review the 1120S, your K-1, your W-2, and 2 years of business returns. Now, your W-2 usually counts, your K-1, maybe. Here's the rule that kills deals. The business has to show enough liquidity to support the income you're claiming. If the money stays in the business, underwriters may not count it even if you pay taxes on it. They're looking at distributions, retained earnings, and whether revenue is trending down. If you're not taking distributions, that income may be reduced or completely excluded. And then there's C corporations. This is the one that hurts the most. Even if you own 100% of the company, the business income doesn't belong to you. For mortgage qualifying, only 2 things count: your W-2 wages and the dividends you actually received. That's it. Business net income doesn't count, retained earnings don't count, potential income doesn't count. If it wasn't paid to you, underwriters don't care. C-Corps are great legally and often terrible for mortgage qualifying. So here's the takeaway. Your CPA's job is to save you on taxes. My job is to help you qualify for a home. Those 2 things don't always align unless you plan ahead. If you're self-employed and even thinking about buying in the next year or 2, this conversation needs to happen early, not after you fall in love with that house.